Hey friends, how you doing? Welcome to another Three Things Thursday. I'm Bill Bourbonnais, and today we're going to talk about a very important topic, unfortunately one that I see all too often. So today we're talking about zero salary in your S corporation. Here are three things you should understand. Now, if you run an S corporation and you're paying yourself zero salary or a very low salary, that's not a tax strategy. That's an audit trigger. I've had the opportunity to review several new tax strategy prospects returns this month, and I've got multiple S corporations I'm seeing with very low or zero officer compensation. Now, the truth is that's not unusual, but it's also not defensible. If you operate through an S corporation and you materially participate in the business, there are three distinctions you need to know to understand about paying yourself. Thing number one, salary and distributions are not interchangeable. If you materially participate in your S corporation, you are required to pay yourself reasonable compensation for the services you perform. Distributions are profit. Salary is payment for work, and they are not substitutes for one another. The IRS has enforced this consistently for decades, and they're very aggressive about it. It's low-hanging fruit for them. If you're actively running the business and paying yourself zero salary, you're asserting that your services have no value. That position does not hold up. Thing number two, reasonable compensation is a defensible position. Reasonable compensation is not whatever minimizes payroll tax. It's not a number that you picked in December, and it's not something that copied from another owner. It's a supportable position based on your role, your duties, industry norms in your industry, geography or regionality, and profitability. One of the more well-known cases where the IRS really succeeded and took a very defensible position for themselves is in Watson versus the United States. In that case, Watson was a CPA, a licensed professional who paid himself a relatively low salary and took large distributions out of his S corporation. The IRS came in and recharacterized those distributions, a substantial portion of them, as wages, and the court agreed. His credentials didn't override the requirement. If you provide services, those services must be reasonably compensated. Thing number three, structure and timing matter. How you pay yourself matters. Taking distributions throughout the year and then trying to do a cleanup later is not a structure, it's exposure. Consistency matters. Documentation matters. Payroll compliance matters. You can't 1099 yourself. You have to run payroll and issue a W-2 and pay payroll taxes. If your compensation approach exists because S corporations save payroll tax, then you don't really have a strategy. You have a slogan. And slogans don't survive audits. So in closing, S corporations are a powerful tool. We've seen this over and over, but they're not self-managing. And if you're operating through an S corporation, your compensation structure should be intentional, supportable, and consistent. It's not about minimizing tax, although that's a benefit. It's about protecting the structure you chose in the first place. If distinctions like this are helpful, Three Things Thursday drops every week. Again, I'm Bill Bourbonnais. Thanks for joining us for this session. Hope to see you next week. Just hit subscribe or follow below, and we'll have another good episode for you. Thanks a lot.